Joining me now to provide insight on the day's market performance is Carl Burgess from Nedbank Private Wealth. Thank you so much for your time. Let's actually take a look at the sharper sell-off on the local equity and currency markets. And of course, the sole reason is Trump tariffs. Just talk to me about what is happening there in the markets. We are seeing the all-share on midday trade down almost 3.5%.
Yeah, thanks for having me. Liberation Day and the Rose Garden hasn't been rosy for any equity investors in the market. So from that perspective, the market's been quite weak. We've been seeing quite a bit of risk sentiment coming down in the local market, as you mentioned. Financials down 5%, market down 3.5%. But again, these tariffs are uncertainty, and markets don't like uncertainty.
Indeed. And we have seen that really filtering through to all the global markets, even the JSE that actually has had quite a good run before Liberation Day, trading at near record highs, but now really feeling that pressure. But really just to dig through the impact on the US economy as well, because things can't be looking good there. I mean, we had alarm bells ringing on a potential recession.
100%. I mean, the growth concerns were already on the table pre these tariff announcements. If you look at the basket across the board, these tariff increases will increase the tariffs into the US around 25 to 30%, and that will be negative for US consumers in the short term. And the question you've got to ask yourself is that what does it do to company margins? And as we're entering earnings season the next couple of weeks in the US, let's see how this possible negative effect affects the growth concerns going forward. But in saying that, markets are volatile, and volatility creates opportunities, I think, from a long-term investor point of view.
Yeah. And actually talking about concerns on economic growth, China is also in the firing line of the US here. Of course, we know the challenges that the Chinese economy has faced, but seeming that this is due to add on to that. How much more pain can China endure due to these tariffs?
Yeah, I mean, you had the 10% broad base and, of course, the additional 34% on Chinese tariffs. They've been stimulating their economy and looking to recover from their weakness. But again, these tariffs will be negative for Chinese exporters. And, of course, I think for the U.S. as well, as a big trading partner of the U.S., we saw BYD, the electric vehicle company, share down around 10%, of course, on the back of those 25% tariffs on autos.
I'm just also wondering on South Africa's side, because we have seen the impact of that on the equity market and on the currency front, which is even more concerning. And I mean, just looking at the inflation picture, the rand had put us in good stead in terms of inflation, and also the Reserve Bank, although it has not been dovish, but I don't necessarily think it has been too hawkish. What then does that mean for South Africa at this point in our fight against inflation and higher interest rates?
Yeah, not a good thing. Definitely not. I mean, I think we were making really good ground on inflation. As you can see, that inflation ranged really at the bottom of the band. With these additional tariffs, possible tariffs that's coming through on our front, around 30%, that is a negative on our growth forecast. I know consensus in the market that we were expecting a stronger GDP number this year, between 1.6 and 1.9, depends on where you read. But I think on that front, it is a concern for inflation, as we are importer, of course, it could affect imports into our country. Yeah.
Well, actually talking about South Africa, because we have our own domestic issues, particularly on the political front, where we've had a huge uncertainty on the budget proposal. And now there's really this widening chasm between the ANC and the DA. How are markets reading that?
Well, if you just look at the screen, definitely not good. If you look at the financials are down 5%, and really, when risk sentiment turns globally and locally, as it's happening at this point, the banks sell off, bond yields have been weak, out 2 to 3%, our 10-year yield around 11% at the moment, out 40 points in a week or so, which is weak. And of course, the currency you've mentioned, dollar and the pound pairs are very weak. So sentiment is weak at the moment. But I think underlyingly, we have been seeing positive momentum on earnings to companies, to the two-pot system, and reduced load shedding. But to your point, I think it is a concern from a growth point of view.
Well, we do have to, before we go to your stock pick, reflect on some of the counters that have found favor with your industry peers. Let's take a look.
Reinet, locally listed and is listed in Amsterdam as well, recently sold British American Tobacco. They've got about 1.5 billion euros in cash on the balance sheet at the moment. That's a large chunk of the balance sheet. Also put a lot of pension assets. It's already trading at about a 40% discount. If you take away the cash, so you're only looking at what you're actually paying for the assets, you get about a 55% discount. That's a lot of upside, even if it just trades to a 20 or 30% discount from here. I think they're going to buy back shares, or they already are. At the moment, that creates more value, or there will be some special dividend or some kind of asset purchase going along the way. Even if they don't, definitely in a difficult economic environment, I do think that 1.5 billion in cash provides you with a lot of optionality. So I like the counter. I think it's an asset play. I think something's going to happen. Mr. Rupert is trying to unlock value in his other investment vehicles as well, like Remgro. They did it with RMH, where they were indirect shareholder basically. So I do think there's some kind of value unlock coming for shareholders, and it's trading at a very deep discount to the real portfolio.
I'm looking at App Loving currently. So this is basically a company that benefits from network effects of app developers coming together into their platform. This company obviously provides the platform, the software to develop these apps, and obviously the marketing and making sure that all these apps that are developed by this richness of skills and resources happen. So if you actually on any app store, chances are, 60 to 70% of the time, the app you're looking for comes from, this App Loving.
Okay.
I want to call, the sandbox, App Loving sandbox.
Okay.
So it's a great company, US listed. It's almost about $100 billion market cap, currently down about, I want to say just over 50%, so call it 51, 52% from their highs of February. So giving us an opportunity for growth here. I mean, I don't foresee individuals, stopping using their favorite apps, especially people in, fitness and people who are addicted to their fitness apps, etc. And one of the biggest announcements in the past 2 weeks is that Garmin is going to stop for example, individuals from using their apps for free. They're also coming into the market and saying, you know what, we think you should subscribe for X amount per month or X amount per year. So more and more apps are heading that direction, meaning that app developers are going to be able to have power to monetize their apps using similar business models. So I'm loving this company at these lower share prices. It still isn't super cheap, but it's really cheap as compared to where it was 2 months ago. So I like App Loving right now.
Well, very, very interesting stocks that we have there. Let's start off with Reinet, an investment holding company. And this comes in a time where, I don't know, I guess there's a polarization in the investment community in terms of investing in investment holding companies because of those discounts. But Reinet seems to really be one of the ones that people like.
Yeah, definitely. The Pension Insurance Corporation assets in the UK, nearly 50% of their NAV. We do like it. We hold it for clients in our client portfolios, and it's defensive. It's sitting with £2 billion worth of cash on the balance sheet. 28% of the NAV is cash, and of course that stubborn discount of 42% discount to NAV. So I think it's defensively positioned. It's got cash, so it gives you optionality on a possible share buyback, corporate action, or even a special dividend. So we like Reinet.
All right. Well, talking about liking things, there's a company that really loves apps. They've called themselves App Lovin'. What do you make of that? It was my first time hearing of it yesterday.
Yeah, App Lovin'. I do watch the price moves. I don't know the underlying company. I did look at it. AI generated advertising for developers. So, this is just really in the AI wheelhouse. I think there's better opportunities out there in that space. This is quite a lofty valuation. so I'm not loving it. It's at 60 times PE, so not cheap. So we prefer some of the other larger names that's recently pulled back.
All right.
Space.
Well, talking about your preferences, let's get to your stock pick for today, Brendan. What are you choosing?
Yeah, we like Absa. We're going to go for Absa Group on the local markets. We've seen this recent pullback. Absa's down 5%. We can go across those banks down quite heavily, as we've mentioned. But I think in saying that, still trading around 6.5 times PE, dividend yield of 9% pre-dividend, a cum dividend. You can still buy it pre the dividend. New management on board. I think from that perspective, earnings have been good. In the recent results, it was up 27% year over year. So this recent pullback, and to my earlier point, is the recent pullback is presenting opportunity. And for long-term investor, this is a good time to be buying Absa.
Woo. And Brendan, this is not even a pullback. I don't know what this is. Indeed, those stocks have nosedived more than 5% at midday. So it's going to be quite interesting to see the developments over the next few trading sessions. Thank you so much for your time and for your insights there on what has moved investors' money. That was Brendan Capstick from Nedbank Private Wealth.